In this video, we will understand about one-person company. The Companies Act 2013 introduced new concepts that did not exist previously in the Companies Act 1956, the introduction of one-person company. In a private company, a minimum of 2 directors and 2 members are required, whereas in a public company, a minimum of 3 directors and minimum of 7 members required. So, a single person could not incorporate a company before the enforcement of the Companies Act 2013. So, if an individual wanted to establish his business before the enforcement of the Companies Act 2013, she could only opt for a sole proprietorship, as there had to be minimum of 2 directors and 2 members required to establish a company. So, now who can form an OPC? So, before the notification dated 1st February 2021, only a natural person who is an Indian citizen and resident in India are allowed to incorporate OPC. So, after this notification, any natural person, that should not be a minor, who is an Indian citizen, whether a resident in India or not. That means now the NRI is also eligible to incorporate a one-person company now. So, what are the benefits of one-person company? First one is separate legal entity. So, the liability of shareholder and director will be limited. In case of sole proprietorship, the liability of proprietor is unlimited. Third one is easy to obtain fund, because now you will be in a structured company, so investor will faith you more, will be more confident. So, it is easy to obtain fund like venture capital angel investor. Fourth one is legal status and social recognition of your business. It gives supplier and customer a sense of confidence in your business. Fifth is perpetual succession. So, what happens while incorporating the OPC? The single member need to appoint a nominee. That is compulsory thing in OPC. You have to appoint a nominee. So, after the member's death, the nominee will run the company in the member's place. Less compliance, exemption available from various provisions under the Companies Act. So, in case of OPC, there are less compliance. Now, the difference between OPC and sole proprietorship. So, what are the difference between the OPC and sole proprietor? First one is, in case of OPC, that has separate legal entity. In sole proprietorship, there is no distinction between business and proprietor. Second, in case of OPC, the liability of shareholder and director is limited, but in case of OPC or in case of sole proprietorship, the liability of sole proprietor is unlimited. Third one is, in case of OPC, income tax rate applicable is same as the private limited company. In case of sole proprietorship, slab rate wise rate applicable has less tax implication. Fourth one is, in case of OPC, compulsory statutory audit of books of account, while in case of sole proprietorship, audit of books of account depend upon the amount of turnover. In case of now fifth one is, in case of OPC, mandatory compliance of provision of company law, while in case of sole proprietorship there is no compulsory provision of that law. Now, come to the frequently asked question. Can a person be a member of more than one OPC? So, the answer is no. A person can be a member in only one OPC, he cannot form more than one OPC. Second one is there any tax advantage in forming an OPC? So, answer is no, there is no specific tax advantage to an OPC over any other form of company. The tax rate and other provisions applicable same as other companies. Now, question number 3, is there any threshold limit for an OPC to mandatory get converted into a private company or a public company? So, the answer is no. The compulsory conversion of OPC upon meeting the criteria of exiting the minimum paid up capital and average turnover was removed in the Companies Act wide second amendment rule 2021. So, thus currently an OPC need not convert into either a private or public company upon increase in its paid up capital and average annual turnover. The question number 4, what is the mandatory compliance that OPC need to observe? So, we will understand the basic mandatory compliance. A, at least one board meeting in each half of the calendar year, and time gap between the two board meetings should not be less than 90 days. B, you have to maintain proper books of account. C, statutory audit of financial statement. D, filing of business income tax return every year before the 30 September. E, filing of financial statement in form AOC 4 and AOC annual return in form MGT 7. Now, question number 5. Who can form an OPC? Question number 5. Who cannot form an OPC? So, a minor cannot form an OPC and foreign citizen will not be eligible to become a member, but a resident but as Indian citizen but he has NRI can also form an OPC. So, a minor and foreign citizen will not be eligible to become a member. Now, sixth one is, how do I convert an OPC to a private limited company? If a person want to convert an OPC into private company, so what is the process? So, answer is, an OPC can convert it voluntary into a private limited company by passing a special resolution after increasing minimum number of members and directors to 2. You have to get no objection certificate in written form from the creditors before the conversion of OPC into private limited company. Thanks for listening me.